Happy Thanksgiving, everyone. I was asked a question on rating stocks. I rate my stocks every weekend, and this is Thanksgiving, so it's not the weekend yet. But I just wanted to answer the question, and I thought I had a video in the Education Center, but if not, that's okay. You need to, update these because stocks change over time. And I rate my stocks using automobiles, but you can use the, 1 through 10 or the standard A, B, C, D, the grade system. You could use guitars, whatever you like. I use um, cars, and I think the top of the line car is a Ferrari. So my Ferrari or my A stock or my 10 would be an Nvidia. And why would that be? Well, because of the relative strength. First of all, performance is, one of my highest of criteria. I need a stock that's performing. It doesn't do any good to have, great, earnings and sales and all that if the stock's not performing. So Nvidia certainly has been performing this year, and recently it's been in this consolidation period. So you might say, well, it's not really an A stock because it's not making a new high, but it's only 3.6% off a new high. It's got, cash flow, return on equity. It's got a little bit of debt, but 1.3 up down volume, which means that there's more, buyers. The volume is more on the upside than the downside. Accumulation distribution rating is a D minus, which is not good. But you could see the fund, all the funds at ownership. The increasing fund ownership from September 22 is 5,382 to September 23, 6,500. So a huge increase in funds that are owning Nvidia. And so this is, what I look for. Also, we've never seen a stock that has a 1.2 trillion market cap with triple digit earnings and sales growth quarter after quarter. This is really remarkable. So this is why I would rate Nvidia an A stock, a 10 stock, or this is my Ferraris, and I only want Ferraris in my portfolios. Why should we settle for anything less in a market like this? Now we have a real uptrending market. And I'm going to show you another one of my stocks that I own that I rate as a Ferrari or a 10, and that's Crowdstrike, because the relative strength, once again, making new highs. This relative strength rating is a little laggy, but you can see there's a actually decreasing fund ownership from last September, increasing overall, but from last September 2019 82. But within the the balance sheet here, it's got cash flow, and this is the health of a stock, a company. They're not going to go out of business as they're increasing their cash flow quarter after quarter, year after year. 30% return on equity. The up down volume 1.7, which is a lot more buyers than sellers. And so we like that. So the accumulation distribution rating is a B plus, composite rating 99. This CrowdStrike has it all. What I like about CrowdStrike is during the correction in the NASDAQ in July, August, September, October, this thing was going up. It was being bought up. And so that's why, the relative strength, I believe, is 97, but it's stronger than most stocks. And I just want to point out that it's making new highs here, 0.2% off its high. So like I say, I put a high priority on performance, and the balance sheet too. It's got to have a nice balance sheet. Speaking of which, Palo Alto Networks is another A stock or a Ferrari that's in the portfolio. And this one I don't own. I just wanted to point out with this one, yeah, it's got, decreasing, kind of sales growth, 24, 26, 20. 20% is fine. And then the earnings grow 66%. That's fine. I mean, it's not going to be 80 every quarter. So I'm not going to cry about that. They have zero debt, which I like, cash flow, huge return on equity. You could see the funds here, increasing funds, increasing their positions. Palo Alto Network has it all. It's only 1% off of its high. Another stock, that I don't own, but I probably should sell some CrowdStrike before the earnings report and get into this one near a buy point. CrowdStrike is extended a little bit. And the last one that I'm going to go over that I do own that I think is a Ferrari is a Microsoft. You can see it's just set up in a base and starting to push away from that base. So it's a 2.8 trillion market cap, double-digit sales and earnings growth, increasing, quarter after quarter here, which is pretty impressive for a company this size. Big cash flow, big return on equity, a little bit of debt, 1.5 up down volume, but like I said, the performance is everything, and this thing is performing. Just massive numbers of funds that own this thing. Anyway, that's enough of the Ferraris. What would get me to sell a stock like that I own? If it's sliced, it's 50 here. If it did that, or was down 5% from my buy point, which is 340. So that's not going to happen. I mean, I would sell before that, before it got to its 50, and because I can't let a profit turn into a loss. But anyway, those four look good. There's more, A stocks, 10. There's more Ferraris in the NASDAQ in the stock market nowadays. It's just that I'm not going to show all of them, showing you the ones that I like and the ones that I own. Another one that I own that I'm going to call a B stock is Lilly. Why is that? Their earnings weren't stellar last quarter. I mean, increasing sales growth, which is what you want to see, but it didn't, as we've rallied here, it's just going sideways. And this tells me that it's setting up in a base, and it's probably going to start catching up here to the others that have broken out. This is a nice little pinching action here in Eli Lilly, tightening up along its 21 EMA. So to me, this is on our ready list, and I think this thing's going to move higher, when it wants to. It's only been 6 weeks in this flat base, but why do I have it a B stock? Come on, Marty, what's wrong with you? Well, it's 5.5% off its high. RS rating's 96, and you can see it's kind of going down. It's not like I said, when the market's going up, this is just going sideways, so its relative strength is going down, and it's weaker. It's got a lot of debt. Cash flow, though, and the return on equity is fine. 1.1 up down volume. 1 would be average, and below 1 would be below average, and above 1 is above average. So 1.1 is fine. Accumulation distribution rating A minus. A lot of funds own this one. So increasing funds, September 22, 4,000, 49.40, well, essentially 4,700. And you can see within the funds, they're increasing their shares. JP Morgan went from, 0.65 to 3.7. A Fidelity Contra, from 5.3 to 5.4. So anyway, this is a B stock. It's got to break out to new highs. I own it. There's no sell signs here. What would be a sell sign? Well, if it's sliced, it's 50. I wouldn't like that. I'd have to sell it because I don't know how low it's going to go and how long that's going to last. And I could always get into other stocks that are stronger. So that would be a sell sign for me. Another B stock is Google. These could both be A stocks, but I'm putting them in the B category because they really haven't been stellar, as the NASDAQ. This thing, it's got tepid growth. Is so big. It's a 1.7 trillion market cap, but it has very little debt, good cash flow, nice return on equity, anything over 15. I like just average up down volume. Accumulation distribution rating is a D plus. The funds, a lot of funds in this thing. 65.71 a year ago, 69.73. So increasing funds, and Fidelity has been increasing shares, but Google is just not. I don't know. I give it a B. I mean, look at the sales growth: 3, 7, and 11. Okay, 11%, double digit is good, and the earnings growth, 17.42, increasing, but it's just, to me, it's not an A stock like a I think Microsoft is doing better, and Nvidia and CrowdStrike and Palo Alto. And there's a lot of them that are doing better than Alphabet. That's why the RS rating is 92. But, Lilly and Google are very good stocks and could certainly make a move. This one's set up in a base as well. Will be on our ready list. So, if they break out and move higher, they'll definitely be A stocks. Like I say, performance is everything. So I'm going to go to the C stock. Oh, by the way, the Ferrari, I rate them Ferrari, and Corvette is a B stock, or yeah. So Corvettes are Eli Lilly and Google. And now the Ford F-150, I have to go automobile stock here for the C stock. The Ford F-150, decent vehicle. It's not going to perform like a Ferrari, but it's steady, durable, and I own one. Anyway, Tesla's just gone sideways, relative strength 87. Yeah, it's rallied off the bottom, came through the 200, has resistance there at the 50. Just okay. The earnings growth and sales growth are declining. Not really ideal. Let me see, accumulation distributions a B minus. It's got a decent cash flow and return on equity, 1.1. Up down volume. So I don't know, it's just not performing. So it does have increasing institutional ownership here, but like I say, it's just not performing. So Tesla is going to be my C stock, or my Ford F-150, if you will. I'm going to move on to D stocks, or a Honda Accord. I'm sorry if you drive a Honda Accord. I'm assigning that to stocks like Crocs. Crocs just has decelerating sales growth, 34.11 to 6, not ideal. Earnings growth 27.11, 9. The stock performance has been pretty wretched here, from 151 down to 74. That was an earnings low, and it's rallied back through its 50 cents, and the little short-term moving average are trading higher. So there is some hope here. This is the stage one base. It needs some work. It's got to get through its 200 here. But if you look at the weekly, Crocs does have real strong cash flow, return on equity. It's a real good company. They have a ton of debt though from their purchase of Hey Dude. And so I'm just going to give this one 29 RS rating. That does have the Lord on its side here. Decreasing ownership from last quarter. Yeah, Crocs is just a D. You can't own it and you can't buy it here. So it's in the D category, or the Honda Accord. And the worst, oh well, wait a minute, I got one more here on my Honda Accord list, and that's Target, because it really sold off hard, RS of 32, but then rallied with earnings, so it probably went from an F to a D. It's got to get through there's 200 there. Let's take a look at its good cash flow, good return on equity. They pay a nice dividend yield, 1.0 up down volume, and it's going nowhere. It's a big company, but it's got to get through the 200, and this is a stage one base as well. It's just taking a long time to form. If you look on the weekly here, this is going to take a while. So Target, definitely a D. Can't own it, can't buy it. And the absolute world's worst car ever built was the Gremlin. So I'm going to put the Gremlin on a lot of these biotech stocks, which have been in just purgatory here for a long time. Bristol Myers doing absolutely nothing, got no growth. I don't see how you could buy this stock. I do own it in a retirement account just for the dividend yield, so I buy it monthly, and I've done it for a long time. But if you're trading this stock, you're not going to buy this stock. I just have it for the yield. It's got cash flow and return on equity, but once again, it's got a ton of debt. The up down volume 0.6. There's more sellers than buyers, and the accumulation distribution rating is D minus. I don't even know what the funds are doing here. Decreasing funds. And if you look at it, on the monthly chart for 25 years, just been in this big base and doing nothing. So definitely Bristol Myers is my go-to stock when I want to bag on laggards. Also Southwest Airlines, my goodness. Yeah, I mean, decreasing earnings, sales growth. Let me see, no cash flow, very little return on equity, 0.8 up down volume, accumulation distribution rating is C minus. This is a mess. Decreasing funds ownership. I don't know what to tell you about love. There's no love for love. This one below it's 200, below it's 50. The short-term moving averages are just going sideways. RS rating of 16. And so that's my Ford Gremlins. You can do a lot of biotech stocks. There are a lot of them in here. This is SRPT Therapeutics, and you can see it's in a clear downtrend. Gap lower, 13 RS. And a lot of them don't have return on equity or cash flow. They're losing money. Ton of debt, so they're relying on a drug to catch fire and sell. So you can find a lot of them in the biotech sector. Anyway, that's how I rate my stocks. The Ferraris are stocks like Nvidia, Crowdstrike, Palo Alto Networks. There's a lot of them that are doing well. I would say the B or the Corvettes are like Eli Lilly and Google. Tesla is a Ford F-150. I wouldn't own it, but if it starts improving, then gets through that buy area, it'll move up to a B or even an A, 21.7% off its high. So it's got work to do, and that's why it's a C or a Ford F-150. The Honda Accord, Crocs, and Target, there's a lot of them in there too. I could put Foot Locker in there, and there's just a lot of them there. And then the Gremlin. The biotechs, the airline stock, love. Oh my God, no love for love. Anyway, that's it. That's how I rate my stocks. You should rate them every weekend because they do change from week to week. Always look at the weekly charts as well. And at mcstockcharts.com, I will just say happy Thanksgiving, and we never give up. Thanks for watching.